Something unfolded in the bond market last week that Wall Street has no interest in helping you grasp, not because it is complicated, but because it is frightening. Because once you understand what it means, you realize that the financial system every American relies on is sending a warning so loud, so clear, and so historically validated that ignoring it is simply no longer viable. The 10-year Treasury yield just climbed from 3.97% in late February 2026 to 4.44% by late March. That is a shift of 47 basis points in roughly 30 days. And the 30-year bond yield is now pushing toward 4.9%, threatening the psychologically devastating 5% threshold. Bond traders have a name for the forces behind this. They call them bond vigilantes. And for the first time in more than a decade, those vigilantes have returned to the field. Treasury auctions for the 2-year, the 5-year, and the 7-year notes all attracted weak demand at the same time last week. Primary dealers, the financial institutions that are literally required to purchase what no one else will, were forced to absorb nearly a quarter of one auction on their own. That figure is double their historical norm. Let that sink in. The emergency buyers had to intervene, and the market is now demanding greater compensation to lend money to the United States government. This is not a technical anomaly. This is not background noise. This is a message, and that message is a code red. Before this video ends, you are going to understand precisely what that message says, precisely why it follows a pattern that has dismantled national economies before, and precisely what you need to do right now to position yourself before the next phase of this pattern unfolds. Stay with me because this one matters. Let me establish the mechanism first, because everything that follows, every historical example, every current data point, every unsettling parallel only makes sense once you grasp the 4-stage framework that every single bond market crisis in history has followed, without exception, without one deviation. This pattern is not a theory. It is a documented, repeatable sequence of cause and effect. Stage 1 is the illusion of stability. This is where cheap money circulates freely. Deficits appear manageable, and investors assume the good times are permanent. Nobody discusses risk. Leverage quietly accumulates in the background. The party feels like it will never end. Stage 2 is overextension. This is where the debt load becomes genuinely unsustainable. Deficits swell. Interest payments begin consuming the budget. Foreign buyers grow uneasy, but markets are still holding. Yields remain contained. The dangerous aspect of stage 2 is that everything still looks fine on the surface. Stage 3 is the trigger. Something breaks, a shock, a war, a policy mistake, an inflation surge, a failed auction. Whatever the catalyst, it is the moment confidence fractures. Bond investors stop buying. They begin selling. Yields spike. The cost of everything rises simultaneously, and governments find themselves cornered because they cannot allow rates to climb and cannot print money without destroying their currency. Stage 4 is the forced resolution. This is where the crisis concludes, but not favorably. It ends through default, hyperinflation, currency devaluation, financial repression, or some devastating combination of all four. Those who understood the pattern came through it. Those who dismissed it paid with their life savings. That is the 4-stage system. Now let me show you exactly how it has played out in history. 3 times, 3 different countries, 3 different decades. The same pattern, identical every single time. The year is 1994. The United States is in its 34th consecutive month of economic expansion. The Dow Jones has just crossed 3,900 for the first time ever. Inflation looks contained. Unemployment is declining. Growth is strong. Bond yields are at historic lows. Every professional on Wall Street is advising clients that rates are going to stay low or fall further. The party is in full swing. This is stage one, the illusion of stability. Then the Federal Reserve does something that changes everything. On February 4th, 1994, Fed Chair Alan Greenspan raises the federal funds rate from 3% to 3.25%, just 25 basis points, barely a nudge. But bond investors had loaded up on leverage and duration. They were all positioned for continued low rates. The nudge became a shockwave. The Fed did not stop. March, April, May, August, November. By the end of 1994, the federal funds rate had gone from 3% to 5.5%, 300 basis points in 9 months. 30-year Treasury yields went from 6.2% to nearly 8%. And in a single year, global bond market investors lost over $1 trillion. $1 trillion in 1 year. Fortune magazine called it the Great Bond Massacre. It was the worst bond market loss in history at that time. And here is the most important detail. Nobody saw it coming. Professional money managers, hedge funds, institutional investors, not a single major player positioned correctly on the short side. They were all caught flat-footed because they were all in stage one. Comfortable, complacent, convinced the pattern did not apply to them. Check, verified, undeniable. Now move forward to 2022, because what happened that year is not ancient history. It is the most recent rehearsal for what is unfolding right now. Coming out of the pandemic, the Federal Reserve had held interest rates near zero for 2 full years. The balance sheet had ballooned from $4 trillion to nearly $9 trillion. Money was essentially free. Deficits were astronomical. The political pressure to keep the party going was enormous. This was stage one, bleeding into stage two. Then inflation arrived. Not a gentle nudge, a freight train. Consumer prices were rising at 8%, 9%, eventually peaking above 9% annually, the highest inflation rate since 1981. The Fed had no choice. They had to hike. And they hiked faster than at any point in modern history, from near zero to over 5% in roughly 12 months. What happened to bonds? The Bloomberg Global Aggregate Bond Index, the broadest benchmark for global government and corporate debt, fell 11% from peak to trough in 2022. That does not sound catastrophic until you translate it into dollar terms. It represents the largest bond market loss in recorded history. Larger than 1994, larger than 2008, over $2.5 trillion in paper losses, $2.5 trillion erased in 1 year. And again, the vast majority of investors were blindsided because they were in stage one, convinced the Fed would always ride to the rescue, convinced that the pattern did not apply this time, convinced that modern monetary theory had somehow repealed the laws of financial physics. It had not. It never does. Check, verified, undeniable. Now travel even further back to a story that almost nobody in Western finance discusses because it is too uncomfortable, too revealing, too close to what is happening right now. The year is 1998. Russia. The Russian government in the late 1990s was deep in stage two of this exact pattern and had been for years. The Soviet collapse had decimated the tax base. Deficits were enormous. The government was financing its operations through short-term treasury-style bonds called GKOs. Foreign investors poured in. Yields were elevated. Returns looked spectacular. Everyone was buying. This was stage one for foreign investors, the illusion of easy money in a market that appeared stable from the outside. But the debt was accumulating at a pace the economy simply could not sustain. Then in the summer of 1998, oil prices collapsed. Russia's primary source of export revenue disappeared. The government could not refinance its obligations. On August 17th, 1998, Russia defaulted on its domestic debt. Simultaneously, it devalued the ruble. Foreign investors lost billions overnight. But here is the detail that sent shockwaves through global markets. The default did not only destroy Russian bondholders, it triggered the collapse of long-term capital management, a massive American hedge fund run by Nobel Prize-winning economists who believed they had constructed a model that could never fail. LTCM held over $125 billion in assets and had taken on derivative positions worth over $1 trillion. When Russian bonds collapsed, their entire leveraged position began to unravel. The Federal Reserve had to orchestrate a private sector rescue to prevent a systemic financial meltdown. The entire global financial system came within a razor's edge of collapse because one government's bond market sent a code red and the world was not listening. Check, verified, undeniable. Now let me map this pattern onto what is happening in the United States right now, step by step, because this is where it becomes personal. This is where it concerns your money, your savings, your retirement, and your future. Let us begin with stage one, the illusion of stability, and trace exactly how America passed through it. For roughly a decade after the 2008 financial crisis, the United States benefited from what economists call the great moderation of interest rates. The Federal Reserve held rates near zero. The government borrowed at historically cheap levels. Deficits expanded, but the cost of servicing the debt remained manageable because rates were so low. In 2020, rates fell to literally zero. Money was free. The government borrowed and spent at a scale not seen since World War II. And bond investors, conditioned by a decade of central bank support, kept buying. This was America in stage one, the illusion of stability reinforced by every rate cut, every quantitative easing program, every emergency liquidity facility the Fed deployed. The party lasted far longer than it had any right to, but stage one always ends. Always. Stage two began in earnest around 2021 and 2022. And it has been picking up speed ever since. The overextension is now almost incomprehensible in scale. Here are the numbers. As of early 2026, the United States national debt has surpassed $39 trillion. Read that again, $39 trillion. The Congressional Budget Office projects a deficit of $1.9 trillion in fiscal year 2026 alone. That is 5.8% of gross domestic product. The 50-year average for deficits is 3.8% of GDP. America is spending nearly double its historical average. And the cost of servicing all this debt, for the first time in the modern era, annual net interest payments on the national debt are projected to reach $1.05 trillion in fiscal year 2026. $1 trillion in interest payments. That number has now surpassed the entire United States defense budget. Think about what that means. America is now spending more money servicing the interest on its past decisions than it spends defending the nation. The debt to GDP ratio sits at 101% today. The CBO projects it will reach 120% by 2036. That would be the highest debt to GDP ratio in American history, surpassing even the peak that immediately followed World War II. But here is the critical distinction. After World War II, America was entering a period of explosive demographic growth, industrial expansion, and global economic dominance. In 2026, America faces an aging population and slowing productivity growth. The conditions that allowed the post-war debt to be managed away simply do not exist anymore. And there is a deeply troubling mathematical reality that almost nobody is discussing. According to the Committee for a Responsible Federal Budget, by fiscal year 2031, the average interest rate paid on the federal debt will exceed the country's rate of economic growth. Economists call this the moment when R exceeds G. In plain terms, it means the cost of borrowing will be growing faster than the economy's capacity to pay for it. Once that happens, debt enters escape velocity. It compounds faster than growth can contain it, and fiscal crisis becomes not a possibility, but a mathematical certainty, unless something changes dramatically. This is stage 2, deep in overextension, and America has been here long enough that the cracks are beginning to show, verified. Now we enter stage 3, the trigger, and this is where everything becomes urgently real because the trigger is not approaching. It has already arrived. Multiple triggers firing at the same time. The first trigger is oil and conflict. On February 28th, 2026, military conflict erupted in the Middle East involving Iran. Within days, Iran announced the closure of the Strait of Hormuz. Roughly 20% of the world's oil and liquefied natural gas flows through that waterway. Brent crude oil prices jumped from $80 a barrel to over $126 in under 10 days. Energy prices are the single most powerful driver of inflation in any economy. When energy surges, everything else follows. Food, transportation, manufacturing, every supply chain in the world becomes more expensive simultaneously. And inflation is the bond market's worst adversary because inflation erodes the real value of fixed income payments. When inflation rises, bond investors demand higher yields to compensate for lost purchasing power. When they demand higher yields, they sell existing bonds. When they sell, prices fall and yields rise, and the spiral begins. The second trigger is the auction market showing cracks. Last week, Treasury auctions for the 2-year, the 5-year, and the 7-year notes all drew weak demand at the same time. This almost never happens. The 2-year auction was particularly alarming. Primary dealers, the buyers of absolute last resort, were forced to absorb nearly 25% of the entire auction. Their 6-month historical average is 11%. They absorbed more than double their usual share, and the securities still had to be priced at a yield 1.8 basis points above where the market was when the auction opened. Traders call this a tail. It means demand was so feeble that the government had to raise the yield at the final moment just to find enough buyers. Yields on the 2-year, the 5-year, and the 7-year Treasury notes have all climbed by over 40 basis points since February 27th. The 10-year yield has moved from 4% to 4.44%. The 30-year is approaching 4.9%. These are not minor moves. These are crisis-level moves in one of the world's most liquid markets. The third trigger is the Federal Reserve's paralysis. Fed Chair Jerome Powell stood before markets on March 30th, 2026 at a Harvard talk and stated the Fed is inclined to take a wait-and-see approach to the oil price shock. He acknowledged the Fed would look past a supply shock as long as inflation expectations remain anchored. But here is the problem. Core PCE, the Fed's preferred inflation gauge, had already reached 3.1% as of January 2026. That is well above the 2% target. And that reading came before the oil shock even materialized. The 2-year Treasury yield recently crossed 4%. That means the bond market is now pricing in not rate cuts, but rate hikes as the Fed's next move. The very last thing this economy needs right now, because rate hikes increase the cost of servicing $39 trillion in debt. That cost is already consuming $1 trillion a year and accelerating. The MOVE index, which tracks volatility in the Treasury market, the bond market's equivalent of the VIX fear gauge, has spiked to levels consistent with price instability and policy dysfunction. The system is fracturing in real time. This is stage 3. The trigger has been pulled, verified, undeniable, and here is what stage 4 looks like. If the pattern completes the way it always has, if bond vigilantes continue selling, yields continue climbing, and the Fed has no choice but to raise rates into a slowing economy, you get stagflation. You get simultaneously rising prices and declining growth, the most corrosive economic environment that exists. The S&P 500 is already down 7% year to date through March 30th, 2026. The VIX fear gauge sits at 30.61. That places it at the 95th percentile of the past 12 months. Mortgage rates are heading back toward 7%. 30-year fixed mortgage rates just rose to 6.46% according to Wolf Street. Every American who wants to purchase a home is watching their buying power evaporate in real time. Every business that needs capital to grow is paying more to access it. The crowding out effect is real and intensifying. If the 30-year Treasury yield breaks and holds above 5%, which several prominent analysts now consider likely if the oil shock persists, it would represent a psychological and technical breaking point that could trigger the kind of broad repricing of risk that markets have not experienced since 2008 or 2022. And here is the part that should keep every viewer of this video wide awake at night. America needs to roll over, meaning refinance, $10 trillion of existing debt this year alone. $10 trillion at higher rates than when it was originally issued. The interest payments are going to accelerate. The deficit is going to widen, and the bond market is going to be asked to absorb more supply at the exact moment it is already showing signs of strain. The math does not work, and the bond market knows it. Now, let me dismantle 3 myths that are standing between you and the reality of what is happening right now. Myth number 1 is that this time is different. People always say this. They said it in 1993 before the Great Bond Massacre. They said it in 2021 before the largest bond losses in history erased $2.5 trillion in a single year. They said it in 1997 before the Asian financial crisis. They said it in 1998 before Russia defaulted. This time is different are the most expensive 4 words in the history of investing. The mechanism is identical every time. Excessive debt, rising inflation, a trigger event, a forced repricing. What changes is the scale. And the scale this time is unprecedented. $39 trillion in national debt, $1 trillion in annual interest payments, $10 trillion to refinance this year alone. There's never been a bond market crisis of this potential magnitude in American history. This time is not different. This time is worse. Myth number 2 is that the Federal Reserve will rescue us. The Fed faces a serious bind. Former Treasury Secretary Janet Yellen explicitly warned about what economists call fiscal dominance. This is the point at which the government's debt load becomes so enormous that the central bank can no longer raise rates without triggering a fiscal crisis. In a normal economy, the Fed raises rates and credit contracts, cooling inflation. But with $39 trillion in debt, every rate hike massively increases the government's interest payments, injecting money back into the economy and actually fueling inflation. The brake has become an accelerator. Heather Long, chief economist for Navy Federal Credit Union, told Fortune magazine directly that the bond market is the new authority in the United States, not the Federal Reserve, not the Treasury, the bond market. And the bond market does not answer to anyone. It does not respond to press conferences or reassurances. It responds to math. And right now, the math is instructing it to demand higher yields. Myth number 3 is that American exceptionalism shields us. The argument goes like this: the dollar is the world's reserve currency. Treasury bonds are the world's safe haven asset, and therefore America can always borrow at manageable rates. This argument ignores the data sitting directly in front of us. Japan, which held $1.2 trillion in US Treasuries as recently as November of last year, has reduced its holdings by $220 billion since January of 2022. China has cut its Treasury holdings by $300 billion from peak levels. Foreign holdings as a share of outstanding U.S. debt have fallen from 34% in 2016 to roughly 30% today. The marginal foreign buyer is pulling back. America is becoming increasingly dependent on domestic buyers to finance its own obligations, and domestic buyers have limits. When those limits are tested, as they were last week, primary dealers have to step in as buyers of last resort. That is not a sign of strength. That is a warning signal. American exceptionalism is not a financial strategy. It is a narrative we use to avoid confronting an uncomfortable truth. The bond market does not care about exceptionalism. It cares about creditworthiness. And right now, it is questioning ours. So what do you actually do? Because understanding without action is just anxiety. And this channel exists to give you both clarity and direction. Here is how to think about this right now. First, understand your exposure. If you are holding long duration bonds, meaning bonds with maturities of 10 years or more, in a rising yield environment, you are exposed to meaningful price losses. A 1% rise in yields can reduce the price of a 30-year bond by roughly 20%. That is not theoretical. That is the mathematics of bond duration. Review your portfolio. Know what you hold. Second, shorter duration is your ally in a rising rate environment. Short-term Treasury bills, currently yielding around 3.8% to 4%, offer attractive income without the price risk of long-duration bonds. You are being compensated reasonably while avoiding the downside. Third, consider real assets. When inflation runs hot, assets with intrinsic value, things that cannot be printed, historically preserve purchasing power. This includes carefully selected real estate, commodities, and inflation-protected securities. Tips: Treasury inflation-protected securities are specifically engineered to adjust their principal value in line with inflation. With core PCE already at 3.1% and energy prices surging, TIPS deserve serious consideration as a portfolio component. Fourth, watch the 5% level on the 30-year Treasury yield closely. If that level breaks and holds, it is a signal that stage 3 is deepening and the probability of a more severe market dislocation rises considerably. Fifth, understand what rising mortgage rates mean for housing. Mortgage rates approaching 7% suppress housing demand and slow price appreciation. If you are planning to buy or sell real estate in the near term, the bond market is the single most important variable in your decision. Sixth, recognize the Fed's dilemma. The Federal Reserve is cornered. If they raise rates to combat inflation, they accelerate the interest cost crisis on $39 trillion of debt. If they cut rates, they risk letting inflation expectations drift higher in a world where oil is at $126 a barrel and climbing. If they hold, bond vigilantes continue testing their resolve and yields rise regardless. There is no clean way out. Understanding this paralysis should shape how you think about every interest rate sensitive asset you own. Seventh, pay attention to the MOVE index. This is the bond market's fear gauge. When it spikes toward levels signaling price instability and policy dysfunction, as it has right now, it is telling you that volatility in bonds is about to leak into every other asset class. Equities, credit, currencies, real estate, everything is downstream of the bond market. When bonds are signaling distress, everything else eventually follows. Eighth, stay liquid. In periods of market dislocation, the investors who survive and thrive are not necessarily the sharpest. They are the most liquid. They hold cash and short-term instruments that can be redeployed when forced selling creates genuine value in beaten down assets. Do not lock up capital in illiquid, long-duration positions when the bond market is flashing a code red. Here is the summary of everything you now understand. The bond market is a mechanism for pricing risk and creditworthiness. It is the most sophisticated truth-telling machine in the history of finance. And right now, that machine is screaming. It is screaming that $39 trillion of national debt with $1 trillion in annual interest payments and a $1.9 trillion deficit in a single year is not sustainable. It is screaming that $10 trillion of debt needs to be refinanced this year at higher rates than when it was first issued. It is screaming that oil at $126 a barrel means inflation is not returning to 2% anytime soon. It is screaming that consecutive weak treasury auctions, primary dealers absorbing double their normal share, 2-year yields crossing 4%, 10-year yields reaching 4.44%, and the 30-year threatening, the psychologically devastating 5% threshold are not random events. They are a pattern. They are stage 3 of a 4-stage system that has repeated itself identically in 1994, in 2022, in 1998, in every major bond market crisis in modern history. The one thing all of those crises shared was that the majority of investors were still in stage 1 right up until the moment stage 3 arrived. They were comfortable, they were complacent, they believed the story that this time would be different. They were wrong. The bond market was right. The bond market is always right. It was right in 1994 when it triggered the Great Bond Massacre and wiped out over $1 trillion. It was right in 2022 when it delivered the worst bond losses in recorded history at $2.5 trillion in a single year. It was right in 1998 when it exposed Russia's debt unsustainability before the government itself acknowledged the problem. And it is right now. The code red has been issued. The question is whether you are listening. If this video gave you something your financial advisor is not telling you, something the mainstream financial media is burying beneath earnings reports and stock tips, hit the subscribe button right now. Because this channel exists for exactly this kind of moment, the moments when the signals are clear, the pattern is documented, and the window to act with intelligence is still open. Watch the next video on this channel because the next chapter of this story is already developing and you need to understand it before it arrives. The bond market has sent its code red. The investors who act on it now will look like geniuses in 2 years. The investors who ignore it will be left wondering how they missed it. Do not miss it. Subscribe. Share this with one person who needs to hear it. And stay with this channel because we are just getting started.